Okay, thanks for joining me. Today we're doing ACCN2 June 2013, questions 2 and the first half of 3, because the second half of question 3 is a written question. So, ACCN2 June 2013, it's the paper I actually did when I was at AS level. So, let's get into it. So, we've got to calculate the inventory for the financial year for the year end 30th of April 2013. So, an assistant accountant has prepared a draft and she's unsure about the treatment. She is unsure about the treatment of the closing inventory. So, the value of the closing inventory used in the draft income was 147,230. So, we're going to need that later. So, the thing in question is this bit. This is what we're going to have to work with to calculate the value. So, mobile phones with a sales value of 36,900 have been damaged. These originally cost 18,450 and it is estimated that they can now be sold for 24,500. To enable the phones to be sold, they need to be repaired for a cost and reprogrammed for a cost. So, under IAS2, which is I think it's second year you start doing IASs, but this is really important. So IAS2 states we should value inventory at cost or net realizable value, and we'll choose which one depending on which one is lower, because we're being prudent. The accounting concepts you've learnt, we're going to pick the lower value. We're going to be a bit under optimistic about our valuation. So what is cost? Well, cost is simply the amount we purchase them for. So these originally cost 18,450. So that's already one half of the 2. So we need to work out what the net realizable value is. So NRV. So how do you work out net realizable value? Well, it's the selling price minus any repairs we'd need to get them into sellable condition. So selling price So our selling price, it's not the original selling price, but it's what it will be after we've repaired it. So it's now estimated it can be sold for 24,500. So the original, we can completely just disregard that now, 36,900, because we can never sell them for that now because we've damaged them. So there's no point in including it in our valuation if there's no chance we can sell them for that. So that's 24,500. So I said it was selling price, minus any repairs. So we've got a repair, and we've also got a reprogram. Well, we need to reprogram them to sell them, so we're going to have to include that. Reprogram. So the repairs are going to cost 3,500, and reprogramming them is going to cost 4,750. So these two are taken away from the selling price to give us our net realizable value of 16,250. So we're going to choose to value them at this 16,250. However, this is not the end of the question. It says calculate the value of the inventory to include in the financial statement. So that's where this 147,230 comes into play. So that inventory valuation was valued at cost. That's vital. So they've valued the inventory with that figure. So we're going to have to lower that valuation because this value is actually lower than that. So the difference between these two is simply one subtracted by the other. So 18,450 minus 16,250, which is 2,200. So that's the difference between the two, how much our inventory valuation is going to lower. So our new closing inventory is going to be 147,230 minus 2,200, which brings us to 145,030, and that's your answer. 6 marks. Only really 2 major calculations to do. So just remember, it's the lower of cost or net realizable value because of IAS2, and we're being prudent. Calculate cost, calculate net realizable value, and pick the lower, and then adjust the inventory depending on how they valued it. So that's that. That's part A. on to part B, and now we're told to calculate the net book value of some machinery. So we're just basically this question we're just calculating the values of things, what we should put in our financial statements. So let's start with this one. So calculate net book value of the machinery. So you can tell this is sort of going to be revenue expenditure versus capital expenditure. What should we include in the valuation of our machinery? So we've got a machine. The machinery costs 78,000. So the highlighter cost 78,000. That's vital. So Leon Limited also paid the following: 5,000 for the machinery to be transported to where they are, 7,540 to have the machinery installed, and 7,800 for an annual maintenance contract. Right, well, I was taught to remember 5 things that get included in the valuation of any asset. So I think it's pronounced P-I-T-T-L, Pittle. So that's price, installation, T, transport, so delivery, training. So if your workforce needs training to work a new computer, you're going to have to include that in the valuation because it costs you that. And the last one is legal fees. So say if you have to pay to build a new building on a land site, that's going to be included in the valuation of that asset. So what's going to be included in our valuation? Well, price, we've got that, 78,000, so we're going to put cost. We have an installation, 7,540 the machinery was installed for. So let's put that in. So installation, that's 7,540. We have a transport figure. So transport was 5,000. Transport. Okay, so the maintenance contract, that's not in our group of 5, so we're not going to include it in our evaluation. However, one more thing we need to do after we've totaled this up. Total comes to 19,540. Okay, when did we buy it? So we purchased it on the 31st of December 2012, and we're doing the financial statements of the 30th of April 2013. The company's policy is to provide a full year's depreciation in the year of purchase, and we're depreciating it 25% per annum, and it doesn't matter if it's reducing balance or straight line, because in the first year it's going to be the same basically no matter what. So we need to reduce this because we do a full year's depreciation no matter how long. We could have had it one day. We could have bought it on the 29th of April and we'd give it a full year's depreciation. So simply 9,540, so the cost value, the value of the asset right now, and we're going to take away 25% in depreciation. So what you can just do is just do 1 minus 0.25 to give us 0.75. So this will be the net book value after depreciation. So that's just going to come to 67905. So now that's your net book value. That's the year's, that's horrendous handwriting, depreciation, and that was the cost. So that's that. Sorry, that's not the year's depreciation. That's 1 minus the depreciation. So the difference between these two figures, the difference between your cost and your net book value, that's your depreciation, sorry. So 9,540 minus that would give you the depreciation for the year, if you wanted to work that out, if you needed to work that out, because some questions they do ask for that. So that's part B. That was 5 marks, that was quite straightforward. Okay, so C is asking you to bring both them questions back and your answers and revise the profit. So original profit was simply, so basically she's just putting numbers in, that's all it is. So original profit 7,867,700. Okay, so let's go back to part A. So where are we? Okay, so part A, we realised our depreciation our inventory fell by 2,200. So we've actually got 2,200 less in current assets, less inventory than we thought we had. So in our inventory valuation, we've actually lost 2,200. So our profit, so what's that going to do to our profit? Well, what I like to do is, so our closing inventory, our CI, has fallen. So what's that mean for our cost of sales? Our cost of sales are going to go up because closing inventory is taken away from cost of sales. So we're taking less away from our cost of sales. Cost of sales gets bigger, so all profits, so gross profit, net profit, are going to go down. So we're going to have to take this away. So basically, whatever you do to your closing inventory, you do the same to your profits. If you reduce your closing inventory by 1,000, your profit will fall by 1,000 because they got the same arrow. Okay, so now I mentioned the depreciation earlier. We're going to need that. So we haven't dealt with that. We didn't deal with that asset at all in the previous. So what did it say? They were unsure of the treatment of the non-current asset, so they completely excluded it. No entries are made, they've excluded it. So they haven't taken into account the depreciation, the difference. So all you need to do is do 90,540 minus 67905 and you'll get your depreciation figure. And I've calculated that to be 22,635. And that's going to be taken away because depreciation is a expense, but it's a non-cash item, but it's still an expense. Okay, what did we not use though in the asset question, but we should include in the calculation of our profit? Well, it's the annual maintenance contract. It's not, so let's just put our title in for that. Maintenance contract. Okay, but it's not as simple as putting 7,800 in. Because we took out the contract in December 31st, 2012. But we're writing the statement on the 30th of April 2013. So we've paid it, we've only got a split amount of that contract in this financial year. So how many months of that contract are in our financial year? So we're going to start at December, so January, February, March, April. So 4 months of that contract expenses are going to be incurred in this financial year. I'm making the statements for now. So how are we going to calculate that? Well, I'm just going to do 7,800, so the full amount of the contract, times by 4/12. So how did I get 4/12? Well, basically, the contract's 12 months long, and 4 of them months are in our financial year. So that's how much the expense is going to be. So that's 2,600. So obviously it's an expense, which brings our profit down. So our new profit is 759,265. So that's right, which is good. Also, if you get say you got something wrong there, say you got this bit wrong, and you got the wrong answer, it wouldn't be the incorrection. Your incorrect answer wouldn't be carried forward. So say as long as you put in the right things from the same things as you put in from this into that, you can get full marks on that and get the previous questions wrong. So don't be worried about marks carried forward and all that. It's error carried forward really. So last question, part 3A. 3B is a written question, so I'm not going to bother doing that because I never do. So Fergie and Kenny are expanding their business and they're buying a lot of laptops for people basically. So what do I need to highlight from this? 6 new sales staff will be employed. They'll be based around the UK. In order to communicate with the sales staff and as part of the budgetary control system, Fergie and Kenny intend to purchase a laptop computer for each of the sales staff. So the laptops will cost 4,350 in total. So all six members of staff's laptops, all the laptop valuations added together is 4,350. It's not each. And it's estimated they'll have a useful life of 3 years and no residual value. So they'll be worth nothing when we finish with them after 3 years. To operate the new budgetary control system, Fergie and Kenny intend to employ an additional member of staff on a salary of $35,000 a year. So, how will this affect our profit? Right, well, the actual purchase of laptops is not an expense. It's just going to lower our bank balance. So it doesn't actually lower our profit, so we can ignore the 4,350. However, where are we? It's estimated they'll have a useful life of 3 years. So we're going to have to do a year's depreciation, like we did with the previous question. We're going to have to do a year's depreciation of these laptops to calculate the expense that will go into our income statement and therefore lower the profit. So depreciation. So how am I going to calculate the depreciation? Well, it's 4,350 in total, and they're going to live for 3 years. They are, so they're going to lose a third of their value in the first year, a third of the value in the second year, and then they're going to lose the rest of that value, the final third, in their final year. So 4,350 over 3 gives me 1,450. So the depreciation for this year is simply 1,450. Okay, so I said the laptop's actual valuation, the purchase of them doesn't lower the profit, but the salary will, 35,000. So that's just simply 35,000 increase in expenses. As simple as that. When it says wages and salaries in your trial balance, you know that's an expense straight away. So 36,450, I believe that is. Yeah. So what's that? It's 2 extra expenses, so we've got a reduction of profit by 36,450. Okay, so onto the bank balance. So the obvious purchase of the laptops, as I said earlier, is not an expense, but it will come out of our bank balance. So that's 4,350. Depreciation. What do we know about depreciation? Well, I've probably said it earlier. It's not a cash item. It doesn't affect our cash. It doesn't lower our bank balance depreciation. So it has no effect on this part. However, the salary does. We are paying them money. So salary, 35,000, and that's it. 39,350. And that's also a reduction because we're paying for things. We haven't sold anything. So that's it. Really quick, that actually. I don't know how many marks that was in total. 8, 13, 18, 24 marks that in total, and I thought they were quite straightforward. So just always make sure you can calculate depreciation easily. You know the difference between capital and revenue expenditure, and IAS2, of course, closing inventory, how to value inventory, and that's about it. Any comments or questions, please email me.